lots of volatility on these markets and lots of uncertainty, and that seems to be building at this stage. Are we still seeing all of this liquidity that we talked about previously floating around the system looking for a home?
It would seem so. I mean, I think there's a few things keeping equity markets up at the moment, and it's kind of coming to a bit of an end, I think, which is why we're seeing a bit of volatility creep in. The first is the wall of money that's hit since QE2, quantitative easing. I only said Queen Elizabeth too. Quantitative easing. And, you know, there's a little bit of concern about the withdrawal of that. So, you know, while it's there, it's definitely finding a home. It's driving bond yields down. It's making equities therefore more attractive because, frankly, who would want to own US treasuries at under 3% when you can buy US equities when they've got a dividend yield close to 3%? So, but that, you know, who knows what happens there? It needs to come to an end at some point, and so people are concerned about what that might mean. The second thing is earnings. Now, earnings, particularly in the US market, where they've now reported their first quarter of earnings, have been well ahead of consensus. I mean, we're talking kind of 8% ahead of what consensus numbers were. So that's kind of made equities a little bit cheaper, I suppose, than people thought because earnings were stronger than they thought. However, what's concerning there is earnings are always driven by the economy. I mean, it's hard to escape the link between corporate earnings and economic growth, and growth is much weaker than people expected. So these corporates are kind of fighting for earnings by improving their margins at the moment. They're not really getting much top line, not much revenue growth, but the earnings are coming through. And so, but you can't have this disconnect for too long. You know, as soon as the economy doesn't grow, corporate earnings will come back at some point. And so our concern, particularly in the US market, where a lot of the money, frankly, has gone this year out of emerging markets into the US market, is that the US equity market starts to have a bit of a growth scare the way the economy is having a bit of a growth scare. So, and then the final thing is corporate cash. You know, corporate cash is so high at the moment, particularly in IT companies in the US. And that's why you're seeing the likes of Microsoft buying Skype and the rumors about Microsoft buying Nokia. I think something like 30% of US tech stocks market cap is cash. And so it's that kind of M&A activity excitement that's also keeping some interest levels in the equity market. But that's a confidence thing. As soon as that evaporates for any of the former reasons, like growth slows or share prices fall, corporate executives aren't going to be buying companies. So that's a very delicate balance that only really happens when you get confident markets. So you take all three of those things, liquidity, earnings, and corporate cash. Corporate cash is probably the only one that still exists in a very strong fashion. The other two starting to look a little bit less likely, and hence investors starting to say, have we taken the equity market a bit too far? Should we pull it back a bit?
How do you weigh that up against what we see in South Africa at this point? Because our growth rate's much better than you're seeing in the United States. We saw that first quarter growth number of 4.8%. But at the same time, our valuations may be looking a little bit stretched. And you could use the example of Walmart and Massmart, where you have Walmart trading in a PE of 12 to 13, Massmart trading on a PE of twice that. So our market can't be looking that attractive to, or our equity market can't be looking that attractive to foreign investors relative to the US.
Look, it's a very good point. If we look at we call it the buy side, the asset management industry in South Africa, and you look 2 years ago, they had about 16% of their money invested offshore. Today it's 21, 22%. So they see the same thing. I think strong rand, expensive local stocks, cheaper offshore stocks, a lot of the money that was invested in the South African market has gone abroad. And I'm not sure it ever comes back, you know, even if the rand weakens somewhat. So that might be a structural shift. And then if you look at the foreign investor coming into South Africa, they have been much more interested in China, Brazil, India in 2010. This year, they've actually been reasonably interested in South Africa because it's defensive. If you look at flows into emerging markets, in 2010, I think there was $95 billion worth of inflows into emerging equity markets. But the vast majority of that went to Brazil and Asia, something like 95% of it. This year, there's been outflows from emerging markets of about $12 billion. But South Africa's had no inflows, no outflows, so it's been net neutral. So we didn't benefit on the way in as much, and we haven't been hurt on the way out as much.
So which other emerging markets are looking attractive at this stage relative to South Africa if you don't want to take your money to the US because of the growth concerns over there?
Well, our strategist likes Russia. Now, Russia, partly oil because they like energy, and partly because that market does have a sort of a political risk discount, corporate governance discount, that our strategists think will narrow over time. And so Russia looks like a particularly interesting market. And in fact, I was telling you about the flows. Most of the inflows into emerging markets this year have gone to the Russian market.
Post QE2, how do you think that's going to be phased out for a start? And do you think we're just going to see liquidity dry up altogether?
I think they've got to start by buying less bonds. I mean, that's the obvious place, because I think once you start changing interest rates, then you potentially affect the man on the street. So you stop buying bonds. That has the effect of meaning there's no bid for US government bonds, so you probably see bond yields rise a bit. And what that then induces is it creates a higher cost of funding for the banking system in the US. And so they have to pass that cost of funding on to the borrower in the US. So that's kind of how the so-called liquidity mechanism would work. The problem that they have is that the cheap money hasn't really stimulated credit growth. You know, it's kind of stimulated activity in the stock market, in the private equity market, you know, that kind of thing, in the bond market. And so it feels like the monetary mechanism in the US is actually broken. And all that's really happening now is it's providing the US government with an ability to fund its debt. And it's kind of, that's, you know, it's, I think someone referred it, I think Bill Gross referred it to as boiling the frog. You know, eventually this thing might just explode.
Do you think we could see a third round of quantitative easing?
I think they have to think of something. I think the market is not, it's not clear enough, particularly with the recent dip in US growth, and we'll see this afternoon with the US employment number. We can't say we're out of the woods yet. I think the banking system has repaired itself, so that's probably a tick. But in terms of the man on the street, has he really felt the benefits of quantitative easing? It's certainly not evident from the US housing market.
You talked about our equity market net neutral inflows or flows this year. Bond market, though, we're still seeing those flows into South African bonds, and that's helping to support that rand. We saw that rand this morning down at 669, and of course a number of other factors like our growth number this week, like the Walmart Massmart deal. But that all seems to be rand supportive. That's true.
It's interesting. I was talking to a client about this very thing this morning. Normally the rand is what we would call, if the risk is on, the rand strengthens, and the risk is off globally. We're talking about global sort of investors in equities. So if equity markets sell off, the rand would weaken. If equity markets rally, the rand would strengthen. And that link seems to have been broken down a little bit recently. So it's very hard to call the rand, to be honest, because you would think if you're bearish on global risk appetite, you bearish on the rand, there's a correlation there. You know, as long as your view's right, you'll be able to get your bet right. What we've seen in this week, actually, particularly yesterday and the day before, is a big sell-off in equity markets, and the rand strengthened. Now, I have a feeling that what might be happening, apart from the Walmart, Massmart stuff that you're talking about, is when there's risk aversion, people go to bonds, and they used to go to just US bonds. Now they're also coming to our bonds, and that's right. So that's what we're seeing. Money into our yielding assets, and rand strengthens.
Would you maintain a very much defensive strategy at the moment, just given the risks that are in the system at the moment?
Yeah, look, I'm not that defensive. I wouldn't be in cash. Our South African strategist prefers cash over stocks at the moment because he doesn't like the seasonality of equities between May and October. Personally, I'm kind of in the buy defensive growth companies with decent dividend yields. So it's kind of boring, but consumer staple companies, healthcare companies, maybe energy companies, those are the areas of the market that I like.
Of course, that dividend making up for any lack of rise in the share price.
Exactly.